Hello, everyone. I see more and more folks are trickling in. Thank you for spending a part of your Halloween afternoon with us. We're delighted you're joining us to talk about some core best interest principles. This is a super hot topic. The DOL's requirements just dropped about 30 minutes ago, so we'll spend a lot of time focusing on that topic. Along with how the DOL's expectations intersect with the SEC's guidance and Reg BI requirements. We are recording today's conversation and plan to share it with you along with the slides. We certainly invite you to participate in the discussion. We have allotted plenty of time near the end of today's session to take up any questions that you will have throughout today's session. I guarantee you'll there's going to be plenty of back and forth and dialogue throughout today's discussion, including our panelists. But take a few seconds, use the chat box, and let us know if you've got questions percolating. And then finally, from a housekeeping perspective, as with many of you, some of us are working from home today, so you may hear some background noise or some, Halloween costumes flying behind us. We appreciate your understanding. Let me begin the conversation with asking our esteemed panelists to introduce themselves. May I ask you, Fred, to begin?
Sure. I'm Fred Reich. I'm a partner with the law firm of Faegre Drinker. I'm an ERISA attorney, and I'm in the Los Angeles office.
Thank you, Fred. Dawn Thompson.
Yeah, my name is Dawn Thompson. I'm the CCO of USA Financial Securities. We're a dual registrant, broker-dealer, RIA. I've been with USA for 15 years, and I'm excited to participate today. Thank you for asking me.
Thank you, Dawn. And Mr. Wagner.
Thanks, Param. I'm Ed Wegener. I am a managing director for Oyster Consulting, and I also run their governance, risk, and compliance practice. Before joining Oyster in 2020, I was the Midwest Regional Director for FINRA.
Thank you, Ed. Randy.
Hey, thanks, Param. Randy Barnes, Director of our Product Engineering here at InvestorCom. Been here for a couple of years and spent 20 plus years in the wealth management fintech space at prior engagements.
Thank you, Randy. And folks, I'm going to be your MC/moderator for today's conversation. I head up product and regulatory strategy here at InvestorCom. If you haven't come across our firm, we are a leading regulatory software provider to wealth managers across North America. Our award-winning and intuitive solutions help our clients, including Dawn's firm, meet regulatory requirements and as well as foster growth. So with that said, what are we going to talk about today? Hey, as if we needed it much of a surprise, we're going to focus plenty of time on the DOL's very timely rule drop a few minutes ago and the proposed best interest principles that they've identified. We've got the panelists here to talk to it at a fairly detailed level, but keep in mind that the rules just dropped. Having said that, majority of our predictions, or not mine, the panelists' predictions have come true. So we'll talk a lot about that. We'll also focus on and recap the recent SEC and FINRA guidance as it relates to the care obligation, and by and large, how does that align with the DOL's expectations? And then finally, if we have time, we'll focus part of the conversation on best practices. How should firms adopt new requirements, new regulations? Where are we in that process? And what are some best practices from a compliance going all the way down to a technology implementation perspective? As I said off the top, we've allotted 15 minutes at the end of today's session to take up your questions. You can use the chat box on the Zoom application. Let's begin. We asked a few conversation-inducing questions prior to today's webinar. By and large, this has been something that we've been doing throughout I'll call it the best interest timeline or journey. We've been bringing the wealth and compliance communities together to really understand how you're tackling the requirements and how you're embracing the set of challenges that are ahead of you. So thank you for participating in the pre-webinar poll. So first we asked, what do you expect to see from the Department of Labor's new rule. A couple of caveats. We started planning for this webinar months ago, and if somebody was running an odds on whether the rule would drop today or not, I would certainly lose. But I'm pretty sure Fred got it spot on. So we asked you all, what do you expect to see? And most of the responses were prior to today, so nobody really had a sneak peek, and accordingly, majority of respondents were unsure. But those who responded saw a lot more comparative cost analysis and disclosures being part of the new requirements. In addition, a change to the 5-part fiduciary test, along with aligning security and annuity best interest requirements. So pretty spot on from what I understand, but we'll talk a little bit more about that as we get into the thick of things. What else? We asked if where you see potential enforcement activity ramping up. And when it comes to that, assessment of reasonably available alternatives has been somewhat of a consistent response across our webinars. It is a consistent topic that comes up in just about every compliance and regulatory gathering. Ed could attest to that. We saw each other a little bit earlier this month. In addition, rollover recommendations and account type analysis is certainly topical for majority of our audience. What else did we see? Do you have a consistent process for making best interest recommendations? Majority do have a consistent process, which is certainly a positive sign. However, the greater majority of those respondents are tackling this in a manual manner. And so we'll talk a little bit today about sort of what observations we've had on behalf of our clients when it comes to those requirements. Finally, we asked, why have you not adopted technology solutions to meet rollover and best interest requirements as it relates to Reg BI? And the responses are fairly evident and somewhat obvious, but it tends to be consistent across our client base. Majority have limited time and resources. So we'll talk about some of those challenges and how they can be embraced at the latter part of our conversation today. All right, that's it for the poll questions. We certainly appreciate the time you've taken to participate in them, and we'll publish these following today's webinar. So with that said, let's jump into the conversation. What else do we need to talk about other than the DOL's retirement investor security set of requirements? Fred was being quite humble with his introduction, in my opinion. I read Fred's blogs, Fred's content fairly religiously along with the rest of the industry. So maybe we begin with you, Fred. What are you seeing in the set of requirements that dropped 30 minutes ago?
The first thing I saw was they're about 600 pages long. So this is, the version you get initially is a triple space typewritten, double space typewritten version. And so it goes on for pages and pages. But there's essentially, I guess, 4 parts to it. There's a new fiduciary definition that is dramatically revised and that will cause a lot more advisors and firms to be fiduciaries. There's some tinkering amendments to prohibited transaction exemption 2020-02, particularly in the rollover area. They're more demanding on the documentation, but significant changes to prohibited transaction exemption 84-24, which sometimes is referred to as the insurance exemption. Think in terms of rollovers to annuities. And then finally, there's the 4th part of it, if you will, is a whole group of other exemptions that have been issued in the past, basically modified to take the kind of retail transactions, the kind of transactions generally that PTE 2020-02 and PTE 84-24 apply to out of them, so that now for advice to plans, IRAs, rollovers, that world, that retirement investor world, there's 3 pieces of authority. There's the new fiduciary definition, which I guess we'll get into a little bit. And then there's PTE 2020-02, which will probably be used for, almost certainly be used by broker-dealers and investment advisors and a few insurance companies, particularly those with career agents. And then there's the new proposed PTE 84-24 that will probably be used for independent producers and smaller insurance companies. So that's, these are just proposals, as you said. We're going to have like a 60-day comment period now, which will take us past the first of the year because it's 60 days from when they're published in the Federal Register, which hasn't happened yet. That'll happen in the next few days, week or two. And then 45 days after they're published will be the hearings. But once that proposal process is all over, the Department of Labor then writes the final regulation, the final exemptions. They're sent to the Office of Management and Budget in the White House to be approved. They're published in the Federal Register, and that's the final rule. And maybe we don't know what the effective date will be, but this whole process could likely mean that the effective date will be in the middle of next year, but the applicability date may be January 1, 2025. That's my guess, that last part. So that's where we are. We've got this new package to talk about today and to work on, advise our clients on.
Fred, real quickly, one of the things that we're asked often, especially after the Florida court decision, was what should firms be doing as a result? And our guidance has been, both because of the uncertainty as well as the SEC's requirements, we advise firms not to make any changes as a result. And I would expect that that guidance would be the same between now and when this is ultimately effective. Is if you're a broker-dealer, an investment advisor, that you continue on the same path that you were doing, provided it was a good path, but you stay on that same path and implement the PTE as you had intended, while looking to see if there's any impactful changes and making sure that you incorporate those by the time they're effective.
Yeah, that was my experience too. Actually, my clients fall into 3 categories on that. The bigger broker-dealers, for example, did exactly what you were talking about, because they'd say, we have thousands of advisors. We can't say comply with this today, tomorrow don't, the day after that comply with this other thing. We have training, we have forms, we have all kinds of stuff we have to do. We can't change on a dime. A few, even of the larger ones, though, said, because of the Florida decision on rollovers, if we find we've made a mistake on a rollover, we're going to correct it, but we're not going to do the last part in the PTE 2020-02, which is to self-report to the Department of Labor, because we don't think we have to anymore. That was the one little exception to what you said. But some of the smaller clients, I think mistakenly said, oh, this whole thing, PTE 2020-02 went away, we don't have to worry about it anymore, and just stopped complying. And I think that was a real mistake. I advised them otherwise, but not at as much as we want everybody to listen to us. It doesn't always happen. So, but I agree that I think that was the best approach. I don't know, Dawn, you had to deal with this more practically.
Yeah, so obviously this has been going back and forth for quite some time, some kind of proposal, it's like 2016, I think. So we're in that same boat where we have all of these financial advisors that have to, at the end of the day, whatever you roll out to them has to be practical. They have to be able to implement it into what they're doing. And we took that exact same approach. You can't tell them to do something one day because we think it might be a rule later and then take it away because we haven't heard anything for a while. So several years ago, I think it was in 2016, we rolled out the beginning stages in more of a narrative approach, which I can speak to a little bit later. But where we did address a lot of this same stuff. And since then, we've just been looking to refine it and make it more easy to implement, but we didn't ever go back and forth in terms of making requirements, retracting them, making requirements and retracting them, because, not just do we have to change or train the financial advisors, but they also have to train their staff. And so that's really difficult to do when the mark keeps moving.
Certainly, there's a lot to say around sort of the shifting of the requirements between sort of court rulings and whatnot. But on that point, Fred, what are there is the counsel of, hey, stay put, don't necessarily do anything. But what are the chances that sort of, as this rule is proposed, it's going through the consultation period, the said requirements are actually going to stick?
I think 2020-02 is here to stay. People, it's modified a little bit. I don't see any basis for challenging the smaller changes. Basically, you have to document more and you have to provide more information to participants and investors, retirement investors. So I think that's good. The Florida court that vacated the rollover part of the rule actually validated 2020-02. And that doesn't get much publicity, but it was affirmed by that court. The new fiduciary definition, the critical parts are that they basically said that the requirement in the 5-part test for recommendations, that you have to provide the recommendations on a regular basis, meaning periodically, or it's not fiduciary advice. That's out of the proposed regulation. They took that out. They actually say you have to be in the business of regularly providing advice to investors generally. Then if you provide individualized advice for a fee, even one time, under the proposed regulation that we just got today, that is fiduciary advice. That's big. That is very, very big. I think we're going to wait until it becomes a final rule next summer, maybe, after being the final versions published in the Federal Register. Undoubtedly, there will be a lawsuit filed against it. That just seems to be, the way of the world nowadays. And so we're going to have to see what happens. But I will tell you that in looking at the package that the DOL has issued, they've anticipated the litigation, and they have built the preamble and the rule to be structured to argue in court. I mean, it's there. For example, and when the Obama era fiduciary rule on the best interest contract exemption was vacated by the Fifth Circuit Court of Appeals and the Chamber of Commerce decision, the court said that that a sales relationship was not a relationship of trust and confidence. Therefore, like a sales pitch would not be fiduciary advice. The court also said that not much has changed since the 1970s in terms of advice being given. I think that's somewhat debatable, but that's what the court said in the Fifth Circuit decision. The DOL is pointing to, since that court decision, the Fifth Circuit decision, we've had the 2019 regulation best interest saying one-time advice by a broker-dealer, a recommendation, is subject to a best interest standard of care of skill, diligence, care, skill, and diligence, where the fiduciary rule is care, skill, diligence, and prudence. That one word difference. Does it really make a difference? A court may say, oh, it looks pretty much the same to us. But anyway, they're going to point to that and say one-time advice. If you look at the 2019 interpretation for the standard of conduct for investment advisors, one-time advice. Well, in both cases for rollovers. You look at the NAIC Model Rule 275, one-time advice, also from 2019. All of that has happened after the Fifth Circuit Court of Appeals decision. I'm sure the DOL will use that to rebut the argument that nothing really has changed since the 1970s. In addition, at one point, where the Department of Labor lists in the fiduciary proposed rule the requirements to be fiduciary advice, at the end of that it says, and we think those taken together establish a reasonable expectation in an investor of a relationship of trust and confidence, using the words right from the Fifth Circuit decision. So they're prepared for the fight. Doesn't mean they're going to win it, doesn't mean they're going to lose it. It just means they know it's coming and there's going to be a fight. Unfortunately, I think we're going to see the same thing as we saw with the Obama era rule. Regardless of the outcome, the private sector is going to have to get into compliance. And so maybe a year or two into compliance, we'll get a final decision. Maybe it goes all the way to the Supreme Court and we'll get a final decision 5 years from now. I mean, it's difficult for the private sector, and it's difficult for insurance companies, independent agents, broker-dealers, investment advisors, banks and trust companies, because you really don't have any choice but to comply, because you don't know what that ultimate court decision is going to be. So you're forced into compliance with a rule, not knowing with 100% certainty whether it will ever be upheld by the courts or not. It's difficult. That's probably more than you were looking for, but I worry. I think a lot about that.
Yeah.
After that, Fred, I'm almost looking forward to reading that tonight. So thanks.
Yeah.
Fred, for folks in our audience who may not necessarily be familiar with some of our lovely industry jargon, the term one-time financial advice, could you just expand on that and just underscore the potential kind of impact by on the proposed set of rules that are coming up?
Sure. The Department of Labor rules have always said, going back to the 70s, if you have discretion over an investment, you are a fiduciary. So you might say that for discretionary management of plan assets or IRA assets, there's a one-part test. Do you have discretion? But for non-discretionary advice, there's a 5-part test. One part, all 5 have to be satisfied or you're not a fiduciary. One part is that the advice has to be given on a regular basis. If advice is only one time, that's not what in the past has been considered regular basis. If the advice or recommendations are episodic, I can make a recommendation today, maybe 3 years from now, I'll make another one, maybe a couple of years after that, another one. That's not regular basis. But if every year I'm making buy, sell, or hold recommendations to you, that I think would satisfy regular basis. The DOL is taking that out. They're just taking it out in this proposal. So that's what I mean by one part advice. It can be sometimes called point in time advice. Under the current definition, wouldn't be fiduciary advice, probably. Under the new definition, would be fiduciary advice. So whether you call it one time or point in time or episodic, none of those were regular basis advice. But the DOL is taking that out. So all those distinctions go away. And you can be a fiduciary for that. So that's the issue. Now, how does that play out? Well, the biggest place that it plays out is with rollover recommendations. Because if I recommend a rollover from a plan to an IRA, historically, the department, over the last several years, the department wanted to say, well, that's all connected. Therefore, the advice to the plan is connected to the advice to the IRA. Therefore, it's regular basis. Satisfied, bam, you're a fiduciary. But the court in Florida, the federal district court, said, nah, the rule says it has to be advice to such plans. So advice to a retirement plan is advice to such plan, but advice to an IRA is advice to a different plan. The Internal Revenue Code calls IRAs plans. The Florida District Court, Federal District Court, threw out the DOL's interpretation. This effectively would set aside that case because there's a whole new regulation that defines one-time advice, which would include a rollover, because a rollover by both the SEC and the DOL is considered to be advice to liquidate your account in the plan, because other than employee stock ownership plans, almost all plans distribute cash. The only way to get cash is to sell the mutual funds in your account in the plan. So it is a securities recommendation, from the perspective of the DOL and the SEC. So that's why it would be considered one-time advice, both under Reg BI, under the investment advisor interpretation, and under the new DOL proposal.
So you just, Fred, you just touched on a fairly key segue, which is sort of anticipating how the DOL's proposed requirements are going to weave into the SEC's care obligation and some of the guidance that they published on the set of requirements going back to March of 2022 on account type recommendations. What do you see as being the sort of any difference, or maybe looking at it another way, do you see the set of requirements kind of coming together and weaving together?
They're very definitely coming together. I mean, it seems pretty obvious to me that there are conversations between the SEC staff and the DOL staff. The similarities are too great to assume that they arrived at them independently. Substantially all, maybe 2/3 or 3/4 of the SEC requirements, of the DOL requirements, are in that SEC staff bulletin that you referred to, the March 2022 one. For example, it has to be a best interest recommendation. You have to look at how the participants invested in the plan and compare it to how they're would be invested in the IRA, taking into account costs, services, that sort of thing. There are a couple of differences, though. One, under the DOL rule, you have to provide the participant with the specific reasons in writing why the rollover is in the participant's best interest. Implied in the SEC guidance, the staff guidance, is that you need to do the analysis, but you don't have to do it in writing. You don't have to provide it in writing. I mean, there isn't literally a requirement for annual retrospective review of the same type as the SEC requires, but as the DOL requires. But the DOL and PTE 2020-02 says, hey, this is modeled on FINRA guidance on the reviews that you need to do for FINRA purposes. So what's that? It's not the same, but it rhymes, I guess is a good way to put it. And actually, Ed could speak more to that than I can. But those requirements are DOL, not explicit SEC. The bulk of it, though, the process, the information has to be examined, the fact that it has to be best interest, that's in both.
Yeah, to that point, Fred, I think, the fact that the DOL did say that they modeled their expectation on the retrospective review on Rule 3120 for FINRA. And if you're a firm that's engaging in retail recommendations, including recommendations to roll over, and you're a broker dealer, you'd have the same expectations under 3120 that you would really under the retrospective review, including the expectation that there be a certification. FINRA requires it under their Rule 3130. And then on the investment advisor space, the same thing under Rule 20647, where you have to assess your programs and your supervision and compliance. So I think that the retrospective review covered under the DOL is very similar to the expectations that you would have for Reg BI and the fiduciary requirements under the advisory standards as well.
Thanks, Ed. Fred, while we're sort of on this topic, maybe I can kind of dive into some of the more nuanced specifics. There was if for folks who've been following this file for some time, there was anticipation that the DOL was working in collaboration with the SEC on sort of mitigating some of the jurisdictional challenges that may potentially come up on this proposal. Having glanced at the proposal, do you see any of those challenges sort of coming to life?
Yeah, I think I think the DOL is saying we think that under Reg BI and under the investment advisor standard of conduct interpretation, that we're pretty much in alignment. We the Department of Labor, imposed some additional requirements. The real issue here, I mean, a little bit moving away from what we've talked about so far, the big change in terms of the industry, which industry is going to be impacted by this, is the insurance industry. And within the insurance industry, it's going to be particularly independent producers. You have the large mutuals with their career agents. Many of them are already using PTE 2020-02, even for annuity rollovers to annuities. But for people using prohibited transaction exemption 8424, for their annuity rollers to annuities, and particularly for independent producers, there's some pretty dramatic changes in here. Much of 2020-02 has been grafted onto 8424. Like I just mentioned, giving in writing to the participant why it's in their best interest to roll over to that annuity. That's part of that new PTE 8424. That's moved over. A fiduciary acknowledgement has moved over. An obligation on the insurance company to supervise compliance with and to do an annual retrospective review put on the insurance company. So the biggest changes here in my mind are, number one, it clarifies that rollovers are fiduciary acts, regardless of any other tests, essentially. And number two, the impact on the insurance industry, and particularly independent agents. I think folks, broker dealers that are already in compliance and investment advisors with PTE 2020-02 and who have been treating rollovers as fiduciary advice in any event, I don't think there's going to be a whole lot of impact on them. I mean, there will be some. Like I said earlier, PTE 2020-02 requires more documentation about the information gathered and analyzed to make a rollover recommendation. And I know it's been hard for everybody to get planned data to do that rollover analysis. I think Dawn could probably talk to that you
I
know?
can't. Yeah, we have faced all those challenges, and I agree with you. Whatever challenges that broker dealers faced previously with having to tackle the 2020-02, now everybody who is relying on the 8424, some of this is going to carry over, and it's going to be plowing brand new ground for a lot of people, specifically insurance advisors. When you talk about having a deliverable, it's just words that you say out loud, but then when you think about actually the practical implementation of what that looks like, that's preparing something that is suitable to be client facing and doing it repetitively and at scale. Because for people who give advice to retail investors, a lot of times that is the bulk of where these assets are coming from qualified plans. So you have to figure most of the new business applications that you're processing are probably unqualified money and are going to be subject to this. At least coming from where we are, we deal with a lot of retirees. So this is a very big deal for us. So yeah, I mean, the actual steps that you would take, you'd have to do either a narrative component, which I know a lot of our peers do. They have like a form that's outlined. A lot of times it's like a 2-pager type of form, although it, if you ask me, way oversimplifies everything. And then what I actually thought was interesting was in those poll questions that you showed at the very beginning, one of the hurdles that people had for not utilizing technology or some other kind of automated and scalable process was the lack of time and resources, which is almost like a paradox, because that's exactly, I mean, that's the crutch, right? You don't have enough time or resources to implement something that is technology. And then here you are doing a manual process, a narrative. It doesn't only take time on the representative that's writing the narrative, but for us, with our principal reviewers, now they're having to review the volume of applications a day, which is huge, in individual writing styles, narratives, missing bullet points, and stuff like that. So it is going to be a challenge. And a lot of these people with the PTE 24 or 8424 are going to be plowing that ground brand new with the release of this.
You know, and thanks for that, because that's a good segue into what we've been seeing as we've been doing the retrospective reviews for our clients. Because you know, I think one of the things, you know, and Fred, you had mentioned this, is that there were firms that thought that, you know, the whole rule was thrown out as a result of the Florida court case. And so we did have some clients that thought that because of the Florida court case, you didn't need to do the retrospective review. And in which case you really do. But, you know, we've been doing these reviews and looking at firms' compliance, and we're seeing good faith attempts to comply. But, you know, where we're seeing challenges that firms are having and opportunities for improvement are around things like training, consistency, the use of appropriate plan information or benchmarking information, quality of documentation, and monitoring for compliance. And so, you know, like we saw in the polling questions, it seems to vary in terms of firms that are using technology supported systems to do their to help with their reviews, and firms that are using manual processes. And the rule doesn't require one or the other. But for those firms that are using technology supported processes, you know, one of the things, you know, I think is that helps with consistency, can provide access to some of that plan information or benchmarking information. It helps with documentation. But one of the things that, you know, you need to keep in mind if you're using those systems is it's really important that, you know, you understand how the systems should be used, that you train the affected users on how to use the system. And then one of the things that I don't know if it was FINRA or the SEC said with respect to Reg BI systems is make sure that if you're using a system that it's consistently being used across and that you're enforcing its use. The challenge is on the manual side, like Don had mentioned, is that you need to make sure that you outline what your process is. And if you're using a form, make sure that the form comports with that process and that you're training people on its use. And importantly, that you're monitoring for compliance, which is a little bit challenging to do if you're using a manual system. But that's where it's most important, because you want to make sure that your processes that you have in place are being consistently applied, and that the what's being done in practice comports with what your policies and what your expectations are. And so that regular monitoring is going to be important, and it can be difficult depending on how you're keeping that information to do that kind of monitoring if you're using a manual system.
That was definitely a challenge we faced was, I mean, I can speak for my own self. If you ask me for a copy of my 401k statement right now, I could not provide one to you. I'd have to go look for it. I'd have to be calling around, having passwords reset. Like, it's not going to happen. And so, and I think I'm in the industry. So I think a lot of clients that these people are sitting with, that these financial advisors are sitting with and asking them, do you have a copy of your statement available with you for your 401k plan so that you can do the analysis on the current costs in that plan? They're not readily transparent. Every statement is a different format, and if you can even get one at all. So having something like access to the IRS Form 5500 databases where you can find this is that exact plan and their fees broken down, or if you cannot, this is a roundabout comparison, like a benchmark, other plans of this size experience these types of fees. It at least gives you some kind of starting point right away. Whenever we're implementing stuff, that's what we're always trying to think of is what does this actually look like in the financial advisor's office when they're sitting down in front of a client? Because if you make it too hard and you make it impossible, you're only ultimately not going to have compliance. And our whole goal is to be compliant. So you have to make it really accessible and really easy to do as much as you possibly can so that it is repeatable.
Love it. This is fantastic advice and knowledge sharing for our audience. And Randy, I know you've been helping a lot of our clients effectively mitigate some of these risks, bring consistencies by way of adopting digital tools. What have you observed? Any consistencies, any practices you want to share with our audience?
Ironically, one of them kind of circles back around to some of the prior conversation around this thought of a carve out where the previous interpretation that it had to be regular basis versus the one-time advice actually can end up causing a problem with how you implement what you're doing, because now you've got to be thinking about it more so in terms of, am I taking path A or path B? And based on that path, what am I doing to execute my, whatever my recommendation is going to be? I think this actually might help us in the industry to just kind of streamline this and say, listen, essentially every time you're doing a rollover, you can default to going down the same path. And I think that'll make things a little bit easier. The other thing is, I know Parham, you and I have kind of this running joke internally, but this concept of kind of crawl, walk, run, right? There's a lot of change that's hitting everybody. This is just a drop in the bucket, when we think about what's coming down over the course of the next 12, 14 months. We heard this, at the NSCP conference earlier, and trying to balance between what's minimally viable to get you out the door versus what's perfect. Both of those have challenges, right? Minimally viable, we've probably all sat around our table with our development partners and whoever else to say, listen, let's just get something out the door that's minimally viable. And then we never go back to improve it. And so now that introduces risk and pain points that just never get corrected. So going beyond that, but not going so far where you're constantly chasing delayed perfection and you're just paralyzed by trying to get it always perfect and you don't implement anything, because then you're wasting time, wasting money, and you've got some disgruntled folks in the field as well as in the home office because they're just stuck with whatever current process they're dealing with. So we try to help, we hear this all the time and just try to coach people through that and just help them understand that what looks right for them, given this kind of this lens of just get somewhere beyond MVP, but don't be paralyzed by perfection.
Love it. Love that feedback.
Maybe one quick comment. Over the last several months, I've had different people hire me to review their PT 2020-02 compliance work, their rollover compliance work, because they've heard about this new rule coming. And I'm finding problems with what they're already doing under the old rule. And I think everybody should take this moment as they examine what they're doing in light of the new proposals, really to look at what they were doing under the old proposals. I mean, I had one call with somebody who didn't realize that recommendations to transfer an IRA to your firm is also considered a rollover by the Department of Labor, subject to PT 2020-02, specific reasons in writing why it's in the best interest of the investor, on and on and on. They didn't even realize that. So for the last couple of years, they've been out of compliance. Another is specific reasons. What are those specific reasons that are good enough? I just saw one where it said the specific reason is that the investor prefers to have active management. The SEC has literally said you can consider preferences, but they're not determinative. So that one standing alone isn't enough. Why is that good for the investor? It is good for the investor because, and others that say, gee, you really ought to, the investor should consider the following things. That's all fine and dandy, but it's the job of the advisor to consider those things before making a best interest recommendation. So I think it's really important now to go back and look, because when you have a new regulation, a new PT like 2020-02, there's a rush to get into compliance. And sometimes in that rush, because there's so many different moving pieces to it, something gets overlooked. And now's a great time to say, hey, I'm going to take the next several months to really look at it, make sure I'm doing it right to begin with, as well as understanding what I may need to change in the future.
You know, just to follow up on that, and something else that we were talking about is just the difference between Reg BI requirements and what's in the DOL with respect to rollovers. And this is just generally too, is, you know, with the DOL's requirement under the original PTE, and what looks like it's going to be revised to, is that there is this expectation that you're documenting this review and in fact disclosing that basis for your recommendation out to customers. Whereas in Reg BI, there's no requirement to document. But if you look at the staff bulletins that have come out recently, I think there might be a difference between what the SEC's expectations are with respect to documentation and what, you know, firms think that might be. And so that's another area where you really want to look, because I think the SEC was trying to provide flexibility to firms in terms of making a determination, so you don't always have to document. But I do think that there's an expectation that, you know, in certain cases that you are, so that certain cases becomes a challenge for firms, is in what cases do you need to document? And I think, you know, one of the things that they mentioned in the staff bulletin around the care obligation is that, you know, where they would expect to see documentation, in addition to the requirements that the DOL has, but is in situations where the recommendation may not look like on its face that it would be in the best interest of the client. So if you're recommending something that's more costly, or you're recommending something that, you know, on its face wouldn't look like there's a reason for a justifiable reason for the recommendation, that those are cases where it would be in your best interest to document, so that you can show to regulators that, hey, these are the factors that we assess. And it goes to what Fred was saying, is that, you know, you can't base it on just one sole criteria. You have to look across, you know, in terms of account type recommendations, the characteristics of the account, the characteristics of the client. What other account types do you have out there? If you're recommending products, you know, what are comparable products that you should be assessing? And then using all of that information, assessing it and making those determinations. And then the question is, do you document? Some firms are just saying, you know what, it's too complicated, we're going to document everything. Well, you don't have to do that. You know, you can, and that would be a safe thing to do. But if you're not going to document your recommendations and the basis for the recommendations, I would definitely have clear procedures about when you do document and what you document, and make sure that you're communicating that to your field force and your supervisors. Just so when the SEC or FINRA or someone else comes in and they ask for that, you can say, well, here's a determination we made. We think it's reasonable. And then you can show that you were documenting in those cases.
I can speak to that as well. In 2022, we did have an SEC audit and a FINRA audit, and they were asking us to be able to substantiate where we had compared the alternatives. So while it's not a requirement in Reg BI that's been published to where you've actually memorialized that the comparisons took place, you might be covered in your procedures if you have sufficient procedures to cover the instances where you would provide additional documentation. We were definitely asked for that. We had it, thankfully. And a while ago, we're doing a lot of it very manual. But even like years ago when this first came out, we were doing all of that very manually, but they do expect to see it, or it at least helps. Like, I'm kind of the opinion that if the regulators ask for something, I'd rather have it to provide them than have a reason to provide them why I don't have it. So, and then you're kind of challenged again with putting all of these various circumstances into buckets. The more variations you have from a common policy, the harder it is to implement in the field and the more opportunity for mistakes. I can also say when we were asked for the memorialization that these alternative comparisons took place, it wasn't just enough that they did take place. We had to know, you're expecting your new business principals then to be experts in a lot of various products, because if your recommendation, for instance, is a variable annuity and they're comparing it against two alternative variable annuities, those are complex products and there's a lot of moving parts. What makes this rider worth paying the extra surrender period? Like those kinds of comparisons are really difficult to memorialize. And the expectation isn't just that a principal read the explanation, say this makes sense. There was an expectation that you go in and you fact check, okay, were the surrender periods that they described accurate of those alternative products that they described? That's a lot of time and that's a lot of work to implement something like that.
This is super helpful. Maybe I can kind of share with our audience a case study that we went through fairly recently, and by and large, this case study or this analysis exercise stemmed from the retrospective review requirements that Ed and Don and Fred have talked about so far. And Randy even said, there is that crawl, walk, run mentality that we kid around about. But we know anecdotally that using technology or some automated solution makes that cost comparative exercise, or that looking up, planned costs from a Form 5500 database, documenting it and digitally delivering it to investors. There's a lot to do there. We heard from our clients that, on average, you save us 2 hours per recommendation. That's a given. The fact that you can instill the degree of, I guess, assurance and consistency across a practice when technology is adopted. When we compiled 4 of our clients' data over the past 12 months for the purpose of this retrospective review exercise, we saw that adopting digital solutions actually fostered growth for the firm. So if you look at the data that's on the screen here, and certainly engage us in terms of kind of learning more about the analysis and the case study, but over a 12-month period, we saw a 2.5x growth when it came to rollover recommendations. So the quantity of rollover recommendations is certainly a growth driver. And if that can be done with a higher degree of compliance and I guess assurance, then there's plenty more growth for the firm and the participants. So let me quickly do a time check. We promised last 15 minutes to address any questions for our audience. Don, Ed, Fred, and Mr. Barnes, if you're ready, we'll transition to the lightning question and answer period. Let's get into it. Okay. Give me one moment. Okay. This came in actually ahead of time. So is there anything out there that defines what a best interest recommendation needs to look like?
I'll jump in first. The answer is not really. There is two parts to it. The first part is the best interest standard of care. You have to satisfy that. And that is essentially a combination, for DOL purposes, I'm talking, combination of the prudent man rule under ERISA and the duty of loyalty under ERISA. So you have to be loyal to the investor and you have to engage in a prudent process. That means you have to gather the information that a knowledgeable person would want to make that decision or recommendations and evaluate it as an experienced, knowledgeable professional looking out for the best interest of the investor. That's the best interest process. So now what are the reasons? The reasons are if you collect the right information for the investor profile, certain needs will almost come off the page at you. But the key is that the recommendation based on the analysis be tied into the investor profile. What does the investor profile indicate that particular person needs? Do they need guaranteed lifetime income, or a certain percent in that, another percent in a variable portfolio that can grow for retirement? It really ties all back into the investor profile and making sure you're getting the right information to make a decision about that individual, not about some generic person.
You know, and on the SEC side, and I think this is consistent exactly with what you said, Fred, you know, they kind of look back at some guidance that FINRA had put out with respect that was under the suitability, but kind of the process looking at first, they have a reasonable basis component where you look and make sure that the product that you're recommending, you have a reasonable basis to recommend that product, and that it's the product is something that you could reasonably recommend to any client. And then there's a customer specific component where you look at the customer's investment objectives, needs, financial situation, et cetera, and then assess the recommendation around, is this appropriate for the customer? And then assessing, because you have to make sure that the recommendations, you're not putting your interests ahead of the client, is looking at things like conflicts of interest that you might have, and make sure if there are any conflicts, that those conflicts are mitigated and not causing you to put the firm or the financial professional's interests ahead of the client. So that's kind of, I mean, that's very general, but that's kind of how they've laid it out in Reg BI.
Thank you. All right. Next question. I'll kind of flip around here for a bit. How do you document the analysis of reasonable alternatives? Is there a top-down technology that we can use relying on the reps notes? Is not a good option. I guess that's what the question is inferring. I certainly have some suggestions.
I'm not going to turn this into an InvestorCom commercial, but I would, honest to God. We started using the reps notes, right? So we started with we called it a rationale letter, and the representative would manually describe their alternatives being plural. So 2 was our requirement. You have your recommendation, and then you have your 2 alternative products or recommendations that you could have made rather than that one. Why did you land where you landed? Like I said, that was really cumbersome, not just on the reps to write, but then you're reading all different kinds of writing styles. People are missing the point or not really driving it home. I mean, not everybody is a writer. So that was really challenging. And then you'd get it to, we're reading it twice. You've got our principals reviewing it. I don't even know how long ago, Parnham, you might know more than I do, started working with InvestorCom to do this. And there's a whole bunch of different stuff once you get in there that Randy can definitely speak to, and it's definitely trained our team about making, because we haven't even touched on this, but the not just like alternative products, but alternative recommendations. Are you recommending an advisory account over a commission account? The account type that needs to be acknowledged.
And the challenge, like you were saying, is if you put that in the hands of your reps, you know, you're going to get very inconsistent in terms of what they consider to be alternatives. Is 2 enough, you know, and those types of things. And so it's hard to define what those alternatives should be, and should the firm be making that determination or the investment professional? And that's where it becomes really difficult when you do that on a manual basis.
Yeah. So what we do here is that you put in your recommendation, and what the software does is it'll actually populate things that are reasonable alternatives to the product that you're recommending. It also lifts a huge burden off of the reps. A lot of them will be comfortable with a product. I mean, you think about how many products are available. They have to be an expert in all of them to know what the alternatives could be. What we found, and this just kind of goes, I think, to summarize the entire basis of Reg BI, but it elevates even the recommendations that are being made, which is positive. So if you put in what your recommendation is, and then it populates 4 alternatives that are available on your product shelf, you actually have the appropriate paperwork or selling agreements in place to offer these products. Sometimes you can be like, oh, I didn't even realize that other company offered this product that is very similar to the one. Maybe it's worth looking into that one. If not, it'll at least just populate what are the available comparisons on your product shelf, and then summarize kind of here's the like rate sum to say this one's better because of this. Your recommendation is actually the better one. So yeah, it does a lot of the manual work for you. And then because it's relying on data from a feed like Morningstar or a reliable data source, you kind of alleviate the pressure of all of the principals on the team that have to go through now and validate, oh, you know, they said that was a 6-year surrender, it's actually an 8. You kind of weed out a lot of those easy mistakes that before those were NIGOs and you were having to go back to the rep, get that corrected, get a new one submitted to you. It just kind of speeds up business processing period for us.
And that's similar to the planned IRA rollover decisions as well as the IRA to IRA decisions. You know, it's kind of the same process, and, you know, having that kind of technology support, and if not technology support, having a really good process that you have in place that you can document is going to be important.
Yeah. Or synthesizing all of the reasons. Sometimes it's hard to organically come up with, I made this recommendation because of the ongoing advice, the opportunity for ongoing advice, wider selection of investment options. If you can have something that's already articulated those, like this, I mean, this program does, honestly, and then it just, you can click them. You're not waiting on an advisor to be able to write now a nice essay and articulate all of that. It's kind of already done for you in a concise way that makes sense.
Writing essays. That's
right.
a good sub theme of this reading exercise we're going to go through in a bit. Maybe I can jump in. Just it's 1:58. There's a couple of questions that came up through today's conversation, and maybe I can point the mic back your way, Fred. There's questions around the 5-part test. Also, what if there is a mistake or there is a correction that needs to be made with respect to the retrospective review exercise? Would you mind just, and then there's a couple of questions that are coming in around the timing of what folks can expect the Department of Labor's proposal to sort of effectively become a rule. Would you mind tackling those in a minute or two?
Sure. Well, just on the retrospective review, one mistake I see people make in terms of corrections, I think there's some materiality standard. That's securities industry talk. For DOL, any mistake, no matter if it's $1 or $1,000, has to be corrected. So you have to correct it. Then the second step, and it has to be corrected within a reasonable period of time after discovery. Most of these are being discovered during the review. And so correction can be an art form. Sometimes it's pretty obvious, like what if you failed to give the fiduciary acknowledgement? Nobody really knows the answer, but I think the answer is, well, then go give the fiduciary acknowledgement. Let's say investment allocations were split, such as somebody didn't get a price break, you know, on the amount invested in an IRA or in a mutual fund, a load mutual fund. Then go back and restructure it. I mean, those conversations are really interesting, and they're beyond the scope of our discussion today. But you have to correct. Then if you to get the benefit of the exemption, you have to self-report to the Department of Labor. Right in PTE 2020-02, it gives you an email address to self-report to. The key there is pointing out in your self-reporting how you have the policies and procedures in place, how you're conforming with regulation or with the exemption, how you've satisfied all the conditions in the exemption, but through a mistake, you had a problem with this one case or with this handful of cases if it's a systemic mistake. Because the Department of Labor's position on that is if you're generally in compliance and they believe you've made a really good effort, they're not going to push back on you. They'll just accept the filing and be done with it. But if you were to go out and say, which we didn't realize the rule applied, we don't have any policies and procedures, then expect to be investigated.
Don't say that.
Don't say that. But if you have a really good case, make your pitch in the filing so that they know it, so that they don't have to ask. But yes, I think you have to correct. I mean, my advice would always be correct. The failure to correct standing alone and the failure to file standing alone means that you don't get the benefit of the exemption, meaning that all the revenue you've made from that investment or investor, you have to pay back. You aren't entitled to keep it because that is your conflict of interest that the exemption protects. So it's a big deal. Absolutely. Was there two parts to that, or did I?
There was we're a bit over time. Let's go to 205 if possible, if you all agree. There's a repeat question around the sort of the regular basis test from the five-part fiduciary test. Would you mind just kind of talking about that a bit?
Yeah, right now you have to provide advice on a regular basis to be considered a non-discretionary fiduciary advisor. Regular basis means there's some contemplation between the parties that there's going to be ongoing advice. The new rule takes that out. I mean, there's nothing really to talk about. It just removes it. Now, they do use the words regular basis in the proposal, but they say if you're in the business of providing investment advice or recommendations on a regular basis. So it's not vis-a-vis that particular investor. It's your business as a whole. So it's gone. I mean, basically the new rule says if it becomes final as it's worded now, if you're providing investment advice or recommendations for compensation, and who isn't, and if it's individualized and based on the particular needs of the plan, the participant, or the IRA, then you're a fiduciary. There is no regular basis. There can be one piece of advice provided. And so the new rule, if it becomes final, will be much more demanding.
And that was the last part of the question. From a timing perspective, what can people expect?
I think we'll see the final regulation next summer. 60 days after it's published in the Federal Register, it becomes a final regulation. I mean, truly final. But I think they'll have a deferred applicability date just to give people time, probably till January 1 of 2025, a little over a year from now. I think but you got to be working on it now based on the proposal. If the bigger you are, the sooner you got to go to work on it, basically.
And also consider that, a lot of the things from the original PT are still in effect now, as well as SEC's Reg BI. So, understand that there are requirements that are required right now.
Yeah, picking up on what Ed said, in particular, look at the SEC staff bulletin from March of 2022. It's the one on account type recommendations. It covers rollovers. It covers it covers gathering information, the investor profile. There's a lot there that will amplify what we've talked about today.
Fred, real quickly, one of the questions was about the new proposal and whether it had the contract and private right of action requirements that were in the 2016 rule, and whether that was in the proposal. And I don't believe that it is. Is that correct?
No, that's that. I think the Fifth Circuit, Chamber of Commerce decision put that one to bed. Basically, the Fifth Circuit held, and it appears the IRS has deferred to that you can't create a private right of action where Congress didn't intend to create one. That's what that contract was intended to do back in the Obama era, the best interest contract exemption. That was what that was all about. There's no contract requirement in here now. So advice, it doesn't matter for advice to plans and participants because there's a private right of action under the law. That was really about advice to IRAs. Advice to IRAs will be subject to whatever private rights of action there are already, negligence, whatever. But there's no new private right of action relative to IRAs.
Fantastic. Don, Fred, Ed, Randy, thank you for your time. Folks, we're a little bit over the 2 o'clock time, and we will, for the last question that came in, we will certainly share a recording of today's conversation so you can watch it on 2X or whatever you decide. So thank you all for your time. Enjoy the rest of your afternoon.
Take care.
Thank you.
Thank you all. Speak soon.
Thank you.
Thanks, guys.
Bye-bye.